What's happening, guys, and welcome back to another Sunday Scan. I hope that you all had a great weekend. I was on vacation last week for the most part. I was at the beach, but I was trading a little bit for my phone here or there, but I mostly took the time to just kind of rest and reset after a really nice market period. And, I come back and the market fell apart. So definitely some interesting variables going on there that I will go over. And then later on, we're going to get into the main watches and we're going to bring Stan on. And he and I have been having just some great conversations about, different market regimes, but also, some strategies to really keep the gains from the previously good periods in the market and when the market's shifting. So make sure that you stay around for that. And then we'll share our main watches, of course. So let's get right into it. Big pullback in the market. You can see whether you watch SPY, SPX, the NASDAQ, anything, you basically had a big correction over the last 2 weeks. And there's really a couple of reasons for that, in my opinion. And I'm going to walk through a couple of charts just to kind of illustrate. Sometimes, when I'm pulling things from like the macro world and how they affect markets, they can be a little bit abstract if they don't have a chart next to them. So I'm going to try to talk through a few of these things just briefly. And help you guys to understand at least where my mindset is coming from of, identifying what is moving the market. And, when you can identify those things, you can basically understand what is the current regime or what are the correlations that are working right now. And that can help you and it can help me to get a better read on the market. And then you can kind of pick your spots and try to find what is relatively strong or relatively weak based on some of those variables. So the first one that I'm going to go through is TNX. So this is just the 10-year Treasury bond yield. And you guys are probably tired of hearing me talk about this, but it's very important to markets. When money managers or anyone is deciding what to do with their pile of money, say it's $1 billion, they're looking at asset classes, things like stocks or things like bonds. And those are like kind of the two classic alternatives. And, you decide your asset allocation based on what's going on. And when you have normal markets, you have an expectation that equities or stocks return on average, let's say 8% a year, and bonds you might get 4 or 5%. And so usually under normal conditions, equities are more attractive. But sometimes when you have a lot of things going wrong in the market at the same time, bonds actually look more attractive because they're perceived as safer. And so instead of taking a lot of risk and a lot of volatility in equities for 8%, sometimes money managers might feel more comfortable taking less risk and getting less return for maybe 4 or 5%. And so I think that what we really saw over the last week was a rotation from some stocks and from some large cap names into the bond market. And there's a couple of reasons for that, in my opinion. But I just want to highlight the fact that usually, like in the previous 6 months of the year, when bond yields were kind of going down, it was because it was seen as inflation coming down. And so that was bullish for stocks or bullish for equities. But now you're in an environment where people are buying bonds because they're scared of, kind of being in stocks. And so you can still have bond yields go down, but that's just a sign that people are piling into bonds, because when bonds go up, which I'll pull up TLT, you can see this is the process of bonds getting bought and people, piling into that. But as bonds go up, the yield on the bond goes down. And so you can kind of see some panic buying during turbulent times. And that's kind of what we've seen during this, mini correction so far. And so bond yields is one thing that I'm watching. And another thing was, the Fed meeting, they really talked about, still taking a cautious approach to rate cuts. And, the economic data has been pretty weak. It's been coming in weaker. And so if the Fed is basically saying we still need more data, they can over tighten, and that can affect stocks negatively, and it could actually lead to a recession if it's done for too long. I don't think that we're on that track. I really don't. But they have to find a balance where they need to make sure that they have inflation under control, and I think that it is, at least the way that they measure it. And so if they keep rates too high for too long, they can really hurt markets. And I think that the market is kind of pricing in them doing that a little bit. So that's why bond yields are on watch for me, and they can kind of give a good guide of what is happening. And then, IWM, we've been watching this kind of leading into the Fed meeting, expecting the Fed to really take a softer stance on rates and want to bring rates down, and so money flows into small caps. But if the Fed is going to basically potentially over tighten or keep rates higher for longer, then that really disproportionately hurts small caps. And so you can see as we ran up, this was where the Fed meeting was. And initially it was seen as very bullish and it had a breakout. And this was kind of the range that we were targeting for IWM, between that, 225, 230 range. And we were having some great trades on the long side leading up to this. And then when you finally had, some of the different variables come out, and then IWM did that real, sharp mean reversion trade back down. And that's what we saw here. So again, like I said, I was on vacation for the most part last week, so I had a few trades with puts, but I definitely was not scaling into the size that I would normally do, but I still had a couple of trades there. The next thing is Amazon. So, earnings week, that's another theme that I think is impacting the markets right now. So we have, the Fed, we have bond yields, we have earnings season. We've had a few gap down names like Amazon, whereas when these things are falling 10% in a day, that can definitely weigh on the indexes, and that can be a big component. So I'm just trying to, highlight what are the reasons why the market is going down. And so that way, when some of those things start to kind of reverse, we can get a better read on when the market will kind of recover to former levels. So, big tech earnings, most of them have been okay, but you've had a few outliers like Amazon, which have gapped down based on their numbers. And then, again, I'll just go through this really quickly, but this is what I was talking about, I think, last week, where it's some of these currency moves and that unwinding of positions can really impact markets. So this is the ratio of, the US dollar to the Japanese yen. And, the Fed is basically, they're doing one thing, and then the Japanese central bank is doing something else. And that basically switch has caused some huge moves in the currency market. And, the currency markets are massive. And when you have large changes there, that can impact things like the Japanese market. And that is what this is right here. And that also spills over into the US markets like we saw at the beginning. So just something to be aware of. Again, I'm not trying to make people macro traders, but more just putting these ideas out there to help you get a read of why some of these things are moving, and they are impacting the US markets. And then finally, we have LMT, some of the defense stocks, because one other variable that is impacting markets right now is some of the tensions and the headlines out of the Middle East. And we saw this, several months ago when we had a similar correction where, once there's strikes and retaliatory strikes, you just don't know. And when you don't know what's going to happen, people need to kind of, hedge more. And so that's like buying the VIX and everything like that. But you can kind of see visually how, the defense sector is rallying on some of these uncertainties. And unfortunately, for the rest of the market, that's a negative, even though a couple of stocks might actually benefit from the conflict, which of course, we don't want to see, but it's just a reality of how things are. So, some of the defense stocks, they're ramping up on the Middle East conflict headlines. We have earnings season, we have, bond yields, and then kind of the last piece to the puzzle, and this is something a little bit more option specific, is that you had very little option direction in the market. And so what that means is basically you didn't have a whole lot of hedges in place and the market was free to move around, where usually the market's kind of pinned in place and it grinds and it spikes, it sells off. But when there's very little option activity kind of keeping the market in place, it can swing around wildly. So in my opinion, that's why we've had the correction that we've had. You had very little activity in the options market to keep things in place. So you had wild swings, and then you have Middle East conflict headlines, you have earnings season, and you have economic data that is soft, and you have the Fed keeping rates higher. And basically all that is a cocktail for why we are in a correction. And so once some of those factors start to reverse, maybe we get some better headlines out of the Middle East, maybe the Fed starts to be a little bit more dovish and say that they'll do a half point cut, or maybe more, or they can cut sooner if they need to, then we can start to see some of that calm down. So that's like on the macro front. And I know that, we have traders of all different styles. Some of them are macro, micro, all different kinds. But even if you aren't trading some of these things, I think it's good to be aware of just why this is happening, because that can help you to get a read on when things turn, and also to tailor your style for what is actually working in the market. Because if you're a long-based trader, and you're unaware of some of these things, you might be trying to buy every single dip, but we keep moving lower because some other factors are in play. So it's just something to be aware of. And then the final thing I want to go over is NUZE, and this was a top watch from last week. And I just want to go over kind of the concept of why this works, and so we can get a better read on some of these things. So we talked about kind of the liquidity trap style of trade, where you have that first high volume day and a big spike up, and then we kind of consolidated. You had those wicks, and every time it kind of was testing the upper end of that channel, you had some shorts kind of slam it back down. And if you do that over the course of let's say a week or 10 days or something like that, eventually it gets, crowded on the short side. And so you can see in this channel, it just kept swiping up, slamming down, swiping up, slamming down. All the while, this area was starting to creep up. And then once you kind of get to a point where the risk level that the shorts are using, if we start to get above that, you can have that big cover come in all at once. And this actually happened after hours. And so we had a nice squeeze out, and that ended up being a really good trade. So this is just an example of a kind of a classic liquidity trap. And we'll see if it sets up again. But most of the time, you have the liquidity trap the first day, the consolidation, you track some shorts, you have some kind of catalyst, it knocks it above those highs, and you have that squeeze out. And if that's the only reason why this was squeezing out, and there's no more volume, no more demand, then that could be the end of it. But if you start to see some demand or some volume come back in and base above those highs, you could have another run. But I just wanted to cover that because we talked about that in depth last week. And so that's really what I just want to go over before we get into our conversation with Stan. And before we bring him on, I just want to say that neither Stan nor I are financial advisors, and these are not buy or sell recommendations. This is for informational and educational purposes only. Now let's bring on Stan. All right, we got Stan on this week. Stan, welcome back. Been very busy out there, and we've been talking. We've been doing some, midday study sessions together. We had a good one on Friday. Went over a lot of thoughts. So, what are you seeing in the market, and what are you really, looking for and looking to trade in the upcoming week?
Yeah, thank you, Chris. So, for me, right now, I think I even actually sent a message over to Nate, I think last week. It was end of July somewhere, and it's more so of easing off a little bit. Easing off in terms of being aggressive into the ideas that are working, and overall just the frequency of trades. Because it just, it had that, in July, there wasn't a day, it seemed like, where 3 to 5 things weren't running. Something was going on every day, and that type of quick liquidity boost is something that we usually look to take advantage of, whether it's on the long or short side. I think opportunities where both sides. It's just pick something that you're familiar with and something that how to trade, and then focus there. But towards end of July, we had that moment where everything was working perfectly. It almost seemed like you couldn't do any wrong. And every time I start to feel in that situation where everything's working nicely, it's everything is being respected, it's there's just no challenge, right? It always raises the guard from it raises some red flags where I start to put up my guard, because everything is going good. I don't know what happens when my risk gets tested, right? All of these setups have been working well, but what happens when your risk gets tested? And because we haven't had that in a while, that's always, something that I consider, to where I'm like, no, I rather start to size down a little bit and be, less aggressive than keep messing around when it's at this current phase. So since then, this week, obviously we've had some great continuation into the some of the plays, but I think overall, I feel there has been some shift. We've noticed it in the market with some of the large caps pulling back. We've noticed it, we're in the midst of earnings season, and generally, it's been gap downs and flushes, and even the gap ups have been selling off. I think was it AMD recently that gapped up to 150s, and then it sold off the following day. So just keeping in mind of the overall market shift is something that always good to have upfront and have it guide your overall thesis.
Yeah, we were discussing kind of like the new regime of when different factors that are driving the market shift. You have things that were closely correlated to the moves beforehand are now reversing, or they're changing, and those like shuffles are times when I tend to be much more careful and cautious, because like you're saying, when things are going very well and you have a good read on the market, it's easy to just keep applying those strategies that have been working. But if you notice a shift underneath, then that's when you really need to scale back, or take it easy, because if you're using old strategies in a new regime or a new market, that's how people can have outlier losses, because things have been going well. They have higher conviction than ever. They're using larger size, and they're doing that at the exact same time where there's a big pivot. So I echo what you're saying completely, with just slowing it down a little bit, treading a little bit carefully, and we just had a great period in the market, and so let's keep those gains. Let's focus on doing good trades and not doing bad trades, and just keeping like a good equity curve going. So I totally echo what you're saying there. So what do you have on watch for the upcoming week? Do you have a couple of names that have a game plan around, or what are you watching?
Yeah, for sure. I have a couple of names that I'm watching, and then just they're kind of sprinkled around because, as I mentioned, we're in the midst of earnings season. So for me, I like to participate in that, and I don't trade the earnings per se. Like going into earnings, I don't really care for the aspect, but I know that once a name is in the crosshairs, it's on the spotlight. Something like Nvidia, Microsoft, Facebook, etc. You generally have a couple of days of volatility surrounding that reporting event, and that's what I'd like to trade or take advantage of. So I have a few of those names, and then some small caps, some of the usual suspects. But yeah, if we can bring up the chart here, and what I'll do is let me just move this out of the way. So the first one that I have on watch is this SERV, SERV, and this reminds me similar to ZAP, OSHA, this Ocean Biomedical, OCEA, NNE, just this type of chart where it has that perpetual squeezer behavior in it, and every time you think it's top, it goes higher, and eventually when everyone forgets about it, of course it's going to pull back to the singles and go back to where it came from. But for right now, it's in the middle of that period where it's just taking from one to the next, and until there's a clear sentiment shift, I don't think it's worth of any sort of sizing. So SERV for me has been on watch. It's been pretty much a daily driver, daily trader type of a name. And even today, I think we had some trades versus this 1580s. But for the upcoming week, I'll just continue to watch it. I'll monitor the this 15-16s range. You can kind of see it on a higher time frame. I'll just use some of these lines. There's a bunch of congestion over here into this $2 range, 15.5s to 17.5s or so, plus minus a few. And for me, ideally on Monday, any sort of quick ramp into this range will be of interest, and then we'll look for fell to follow through momentum, and then we'll use some of these key levels on the way down for some of the covers. But essentially, looking at this daily chart, if you need to see some other examples of how they could, end up working out, like I said, this Osher is one of them. RGS, similar, right? It's not so much identical chart, but the behavior, the way this move happens is pretty much the same across ZAP, NNE. There's just been a bunch of other examples as well, but anyways, that's essentially where a serve is being placed into that category. So that's on watch on Monday. And then the next one that I have are a couple of liquidity trap potentials. So this RDHL is one of them, and PMEC is the other. Again, just liquidity trap. Chris, you did a fantastic video on that. So for anyone not familiar, you can go back and watch the video. But essentially, RDHL, we had this nice volume yesterday, 360 or whatever this was. 360 million. And today, we're down to essentially a 10 of that, a little bit less than 10% of that, 27 million. And the price relatively held, right? So there's some key levels on the higher time frame versus this, plus minus 50s, 54s. But on Monday, Tuesday, T+1, etc. I'll watch it. If we start to get that bid, if we start to get any sort of a momentum building into it, and then if it builds over 70, 80s, etc., it may trigger into a much bigger move. So that will be on watch on for next week. And then similar with PMEC, we had a nice move a couple of days ago, I think on Wednesday, right over here on so about 100 million volume, and then the following day, it went down to 5 million, and price held. And today, it's a little bit lower. Obviously, there was a little sell, but the volume went to 1.7 million. So this again will be something on watch. No real interest until we build over this 90 to $1 level, and then ideally trigger into this 120, 130s for the liquidity trap aspect. Next one that I haven't watched is this SAVA, SAVA. Impressive rebound here off the single digits, off the nines. I actually saw Nate mention earlier in the room, and he put something versus 28s, and I'm like, that for sure must have been a typo. He probably meant 18. Because I remember looking at this not too long ago. It was down here in the 11, 12s. So this definitely climbed up on the top, top of the main watches for this coming week. But it's SAVA, right? It's SAVA. I mean, this, Cassava Science, this particular ticker always, it always does extra of everything. It always goes further than you think. It always, goes higher, and then it pulls back further. So that to me gets built into the thesis always. It helps me with sizing. It helps me with range anticipation, etc. So ideally next week we Monday, Tuesday, whatever it decides, some sort of a gap up would be ideal. Even if we gap into this 30s, 31, 32s, the higher the better. But essentially a gap up does its morning dance, morning move, shove, and then fail to follow through. We can use some levels from this week as well. Bigger move, into this 24 to 27 or so failure, and then we might see some retracement. Again, I don't have a bearish view on this. I don't really, I'm not interested in fading this back down to the teens or to the singles. I'm interested in taking advantage of the opportunities I'm familiar with, something like a gap up parabolic, and then once the move is done, move on and go from there. The next ones that I have are I have VXX and UVXY. Obviously these are volatility instruments. So make sure that you know what you're getting yourself into when you start trading these. They move very quick. The tape itself is different. So they don't trade the same as equities. But I have these couple of volatility instruments on watch because we had a nice gap up. We had a big move on Friday, and it's something that if the market continues, or if the market does a gap down flush and then reverses, VXX or UVXY is another way to capture some of that move, right? Instead of either equity options or whatever else avenue you may choose from. So for me, just watching the volatility instruments, just watching how the market is doing, and essentially if we gap down and flush, I don't mind getting into some sort of a fail to follow through momentum here, and just monitor and work the position, manage the trade overall as the market itself is developing throughout the day. So I don't always trade these. I trade these mainly around high levels of volatility, obviously. So something like we've seen over the past couple of days, weeks, where the market has been pulling back. So if that fear continues, or if fear starts to build, etc., these are just another vehicle to get exposure into the market for me. And the last, I have just a basket of name. Amazon. I'm just going to go over them real quickly and just share the overall idea. Amazon, Microsoft, Facebook or Meta, AMD, Nvidia, obviously. So all of these names, right? This, the big names, the tech names here. For me, what I'm watching is just, again, we're in the midst of earnings season. Companies are reporting. These companies they do feed off each other. So if a lot of them are weak, the rest of them may follow, etc. So it's just something that I keep in mind. And given that we're in the midst of earnings season, I like to keep these on watch for at least a couple of days after they report, because it offers good opportunities throughout the day that we can take advantage of. For instance, this AMD, right? They reported, it ran up, and then the next day it just completely failed and then unwound, and then the following day as well, on Thursday, even a bigger move than it did on Wednesday after the earnings. So this is kind of what I'm interested in, right? The couple of days after the earnings period for these names, and it doesn't have to be just 1 or 2 days. It could be 2, 3, 4 days. Just the whole point is, when volatility is there, when earnings are there, or you have some sort of a catalyst that impacts the company at a fundamental level, I like to partake in those. And that pretty much sums up the watches for me for next week, Chris. So I'll pass it back to you. See if you can share with us what are you watching.
Yeah, definitely. And I know that you already have NVIDIA up there, so I'll start with that one. So yeah, we saw a huge flush down in NVIDIA over the past week, and then we had that really nice rebound day once it was trading off that 100 level or so. And then I think it caught a lot of people off guard because you had that rally from basically 100 to 120, and people are like, this thing's moving like a small cap. This is a $2 or $3 trillion company, and it's moving 20% in the course of a day or two. And so I think that once you had that big bounce, and then you had a lot of people kind of chasing it there, and then you had some news change and everything, and it flushed back down. And now it kind of retested that 100 level. It's starting to act a little bit more heavy than before. And for me, this isn't to say that it doesn't have a good bounce in its future, but this is different than when it just has a super clean ride down. Shorts are over positioned to the downside, and then it has like a fresh bounce waiting to happen, versus it already had that fresh bounce, and now you have some longs that are kind of on the wrong side. And so typically when I see this type of action, I'm looking for it to kind of reset or like find some equilibrium. And that might be a couple of days of consolidation or a week or something before it really picks a new trend where some large money flows kind of go back into the sector. And so maybe, towards the end of next week, we start to see some basing and a new direction, and it'll be on watch then. But just for myself, I'm cautious of trying to play a bounce. If it every time it starts to bounce, it just like struggles a little bit, and it goes up to 108, 110, fades back down. Those are the ones that they can just slowly grind you and chop you up, whereas something else might be a little bit easier for me to focus on bouncing. So I just want to see a little bit of consolidation in NVIDIA before I really start to focus in on it, but it is on watch for me for the next week. And then the next one that I really have on watch is Meta. And so this one, I talked about it last week, how I thought that they could have some issues going into earnings season because they've been really increasing their capital expenditures, but we didn't know if their earnings per share and the revenue was actually improving from that. And so I thought that if their CapEx went up, but the earnings and the revenue didn't match that, then we could have a big flush down. But that wasn't really the case. They reported very solid earnings. They beat on earnings and on revenue. And so what that tells me is that they're spending a lot on their AI, their capital expenditures, but they're actually seeing some good rewards from that. And so that's very different from like when they were going after the metaverse stuff, where it's like a big, capital expenditure, but there was no profit from it. And that's why it got hammered so hard in, I think, 2022. And so it's encouraging. And I'm flipping my bias now that if they have, good CapEx, like a lot of CapEx, but they're actually seeing some benefits from it, then that's a positive sign. And it also showed a lot of relative strength, even during this market weakness. So a name like this, once it kind of settles, like Stan was saying, after earnings, and after like the options clear out and everything from the earnings week, because that can really, hold things in a range. I'm going to be watching this for continued upside or for upside in general, especially on the day that the market bounces. I think that this could be a go-to because there aren't really like the same type of bag holders in this as some of the other stocks. So I think that you had like a gap up on earnings and just kind of settled back and it's consolidating. So I think if we have a good, strong day in the market, I'm happy to flip my bias on this to a more, bullish relative strength kind of name. And their earnings report kind of helped me flip my bias on that. So that was good. And then the next one that we have on watch is TLT. So this had some huge moves over the past week or so. And this is really, this is the 20-year bond. And just a little like side note on bond yields. For the first like kind of half of 2024, we talked about how in an environment where inflation has been the risk, bond yields rising, those are bad for especially small caps and stocks in general, as rates are high. And now, usually in that kind of regime, when bond yields were to go down, you would have kind of a positive effect on stocks. But it gets to a point where if bond yields are moving for a different set of reasons, then they can have a different correlation. And that's kind of what we were talking about with the regime change. And so right now what's happening is as the Fed is still keeping rates a little bit higher for now, they plan on cutting, but we're starting to see some weak economic data while at the same time they have rates high. And so what is happening is that people are exiting some equities and they're putting that money into bonds. And it's always about kind of comparison. For big institutional money, they're looking at, okay, in equities, we're looking to get, 8% annual returns. That's kind of like the standard. But if you have a situation where rates are high, economic data is starting to weaken, and some of the earnings are like so-so, maybe they're saying, okay, we expect equities to return 5% or 6%. And so what they'll do is they'll look at bonds and say, I can either pay, I can either have a lot of risk by holding equities and get 5 or 6%, or I can hold bonds and get 4.5% for almost zero risk because, I can, if they're short term enough or anything, they can kind of get a guaranteed return on that. So I think we had a bit of a pivot with some of the data that came out, and that money flowed into bonds. And that's why you have things like TLT spiking. So, that's been a big trend over the last week or two. And I think if we had some data where it was like, okay, maybe the recessionary pressures are not as big of a risk, you could have this have a nice slam down as, yields start to come back up. So I would be looking at this for a possible mean reversion trade if certain data came out, and I will alert the room when I'm looking at a trade like this. But you want it to get pretty overextended, and then you can get a nice mean reversion trade on that. And I also, some of the tensions in the Middle East and other things, just when there's a lot of uncertainty, people tend to go into bonds and out of equities. And I think that that's been a lot of what we've been seeing over the past 2 weeks. So that is on watch, TLT for me. And then the next one, we have CRWD. So we talked about this one, I think 2 weeks ago or maybe last week, how it was at a decision point when it was a bit higher, and it was saying that what comes next after this global outage and their problems? Do they retain most of their customers, and is everything all good and people just forget about it? Or do they start to have lawsuits against them? Does everyone say, everyone's blaming CrowdStrike for why they're missing earnings or doing whatever, and now they're saying, okay, we want compensation for that, and then they might be sued and forced to give out money, and that affects their earnings and everything else. So CrowdStrike was slammed down as a couple of companies came forward and said that we want to sue, we want some compensation, and so that had a nice move down. I had some trades on it over the past week with puts, and that was just a really nice move down, and what I call like the path of least resistance, where especially in a weak market, what is acting unusually weak? What has a reason to have sellers in it? And then you're just kind of looking for what is moving down very smoothly, and then just trying joining that trend, either with puts in my case, or sometimes people might short it. So this is on watch to see if it gets down far enough. I would be looking for a bounce on this. Because nothing goes straight down forever. It gets revalued, it gets overextended, people get a little bit confident in it, and then they get off sides, and you have a nice swipe up. So CrowdStrike is on watch for me for a bounce in the upcoming week, and if it is staying weak, then I'll move on to something else, but that's just on watch. And then the next one that we have, Stan, is LMT. So Lockheed, again, this is one of those companies where, unfortunately, as there are global tensions and there's a lot of fear in the market, these tend to do well because while some companies might be less certain about the earnings in a more conflict-driven environment, unfortunately, the defense names, those are ones that do well. And so these are ones just to watch, not necessarily to play them on the long side. You can, especially if there's headlines, and they can sometimes be a way to hedge a portfolio by having something like that. To balance some of the downward moves of some other names. But also, if you have some good news, whereas conflicts are settling down, or like there's a treaty or something, these can be great for mean reversion. And we all hope that as conflict headlines kind of settle down and things become more peaceful, that some of these names come in. So LMT is on watch for really either case, but it's very headline driven. So you can see from the chart, you can have some significant range, depending on the headline. So there is some opportunity there to either hedge a portfolio or to possibly play a mean reversion trade if we get some better news in the near future. Yeah, and so those are the names that are on watch for me this week. And Stan, do you have any comments on any of those?
No, I think actually, I was just looking at LMT, and this is a nice little move here today. So I might keep it on watch, because even on the daily, right, it's we're getting into that extended range. No real interest right now, but nothing wrong with glancing at it in the coming week to see if something may come up. Yep.
Excellent. Well, that's all I have on watch for the week. And Stan, I appreciate you sharing your watches for the week. I hope that everyone has a great and safe weekend. And again, just to reiterate the point that when you have new market regimes, when you have new variables coming into play, go slowly. One trade at a time. You don't need a lot of trades. You need good trades. And if you don't have a lot of good trades or any good trades, then just be patient and wait for it, because what really hurts traders, I think, is just the urge to always do something, even when they're in an environment where the best thing for them to do is just to watch and observe, instead of getting into something that they're not familiar with, having losses, and then when they're seeing the market clearly, they have to size down because they have to dig themselves out of a hole. So that would be kind of my closing thought with that.
Absolutely.
Yeah. All right. Well, Stan, have a great week. Thanks for coming on, and I hope that everyone has a good weekend.
Great. Thanks, Chris. You as well. Have a good one.